Hey everyone, and welcome back to the channel. Today, we're diving deep into the silver market, but we're not just talking about price charts. We're talking about something far more critical, something the big players are watching with hawk eyes: inventory. Imagine waking up one morning to see silver has rocketed to $80 an ounce. The shock isn't just the price, it's the reason behind it. The real story, the one that could ignite the market, is unfolding right now in the COMEX vaults. So, what's going on? While most people are fixated on daily price movements, the professionals, the insiders, are focused on inventory levels, specifically the amount of registered silver. This is the silver that is actually available for immediate delivery to buyers who want to take physical possession. And right now, that pile of registered silver is getting dangerously small. Think of it like a grocery store. There might be a lot of food in the back warehouse, but if the shelves up front are nearly empty, people start to get nervous. That's the feeling spreading through the silver market. Let's break down the difference between registered and eligible silver, because this distinction is crucial. Eligible silver is simply silver that meets the exchange's standards and is stored in a COMEX-approved vault. It's owned by someone, but it's not for sale on the exchange. It's like your personal savings account. Registered silver, on the other hand, is eligible silver whose owner has filed paperwork to make it available for delivery against a futures contract. This is the for sale shelf. The problem is, owners can switch their silver from registered back to eligible with a simple click, instantly removing it from the available supply. As the registered category shrinks, the market gets a serious case of the jitters. This isn't just about numbers, it's about psychology. Markets run on confidence. The entire futures market is built on the promise that if you stand for delivery, you will get your physical metal. But what happens when that confidence starts to crack? What happens when traders look at the dwindling pile of registered silver and compare it to the massive mountain of paper claims against it? They start to question if the promise can be kept. This is where fear and a sense of scarcity kick in. The perception of a shortage can become a self-fulfilling prophecy, triggering a frantic rush to secure physical metal before it's all gone. This potential rush is what could lead to a massive supply squeeze. A supply squeeze happens when there's not enough physical commodity to cover all the delivery demands from futures contracts. In this scenario, those who have sold silver short, betting the price will go down, are forced to buy back their positions at any price to avoid defaulting on delivery. This creates a frantic buying frenzy that can send prices parabolic, almost overnight. We're not talking about a slow, steady climb. We're talking about a violent, explosive price surge. Let's not forget silver's unique dual identity. It's not just an investment asset like gold, it's also a critical industrial metal. The demand is relentless. It's in your phone, your laptop, solar panels, electric vehicles, and countless medical applications. This industrial demand creates a solid floor for the price. Unlike purely speculative assets, silver is constantly being consumed by industry, which means that physical supply is always being drawn down, regardless of what investors are doing. So you have steady industrial demand on one side and growing investment demand on the other, both putting pressure on a finite and shrinking available supply. It's a classic recipe for a price explosion. Now, let's add another layer of complexity: algorithmic trading. Today's markets are dominated by high-speed computer programs that execute trades in milliseconds based on specific signals. These algorithms are programmed to react to data points like inventory levels, trading volume, and price momentum. Imagine a scenario where COMEX inventory data drops below a critical threshold. This could trigger a cascade of buy orders from thousands of algorithms simultaneously. These bots don't feel fear or greed, they just execute commands. Such a synchronized buying wave could empty the registered vaults in a flash, launching the price into uncharted territory before most human traders even have time to react. The computers could ignite the squeeze. So, what are the key signals to watch for? First, keep a close eye on the daily COMEX warehouse stock reports. Watch the registered category specifically. See if large amounts are being moved out or reclassified to eligible. Second, look at the open interest, the total number of outstanding futures contracts. If open interest remains high while registered inventory plummets, that's a major red flag. It means the paper claims are far outweighing the available physical metal. Finally, pay attention to the premiums on physical silver coins and bars. If the price to get your hands on actual silver soars far above the paper spot price, it's a clear sign that the physical market is tightening dramatically and a disconnect is happening. The big question, the multi-trillion-dollar question, is this: will confidence in the paper market hold? For decades, the system has worked because the vast majority of traders never ask for their physical metal. They just roll their contracts over or settle in cash. But we're entering a period of deep uncertainty and distrust in traditional financial systems. If a significant number of contract holders decide they'd rather have the real thing, the system could face its greatest test. The moment the market believes that the promise of delivery might not be honored, the game changes completely. It would no longer be about trading paper promises. It It would be a mad dash for the real, tangible asset. This isn't a prediction that silver will hit $80 tomorrow. It's an analysis of the underlying pressures building beneath the surface. The conditions for an explosive move are aligning in a way we haven't seen in decades. The combination of dwindling registered inventory, unwavering industrial demand, growing investment interest, and the potential for an algorithmic buying frenzy creates a very volatile cocktail. The shock won't be the price itself, but the speed at which it can happen when confidence in the paper promise finally evaporates. The fuse is being lit by the disappearing inventory in the COMEX vaults. The only question left is how long it is. This is one of the most fascinating and potentially explosive setups in the financial world right now. It pays to be informed and understand the mechanics behind the market. Don't just watch the price, watch the inventory. That's where the real story is being told. Thanks for watching today. If you found this breakdown helpful, make sure to hit that like button and subscribe for more deep dives into the markets. Let me know your thoughts on the silver situation in the comments below. Until next time, stay sharp and informed. Have you ever looked at the silver market and wondered what really makes it tick? It's not just about numbers on a screen. There's a powerful story of pressure, psychology, and a clash between giants and the little guy. Today, we're diving deep into the forces that could ignite the next major silver bull run. First, let's talk about pressure. Think of the silver market like a coiled spring. For years, this spring has been compressed, and the tension is building. On one side, you have the paper market, where financial instruments like futures and ETFs are traded. This is where big banks and institutional players often hold massive short positions, essentially betting that the price will go down or stay flat. Their influence can suppress the price, creating an artificial cap. But on the other side, you have the physical market, and this is where things get really interesting. Demand for physical silver is relentlessly growing. It's not just for coins and bars anymore. Silver is a critical component in so many modern technologies. It's in your smartphone, your laptop, and the solar panels powering our future. Electric vehicles use a surprising amount of silver too. As we push for a greener, more technologically advanced world, industrial demand for silver isn't just steady, it's accelerating. This creates a fundamental, non-negotiable pull on the available supply. Now, let's bring in the retail investor. That's people like you and me. When a small group of us buy silver, it's a drop in the ocean. But when millions of retail investors around the world start buying physical silver at the same time, that drop becomes a tidal wave. We've seen this happen before. Remember the silver squeeze movements? They showed the world what happens when collective retail action challenges the paper market. When retail investors decide to take delivery of physical metal instead of just trading paper, they start to drain the actual physical supply from vaults like the COMEX. This is the core of the conflict. A massive, often suppressed paper market versus a very real and increasingly tight physical market. The industrial buyers need physical silver to make their products. They don't want paper contracts. They need the actual metal. When they and a horde of retail investors all rush for the door at the same time, demanding physical delivery, that's when the paper game can unravel. The vaults might not have enough registered silver to cover all the claims. This brings us to the psychology of a bull run. Market movements aren't just about supply and demand, they're driven by human emotion, fear, and greed. A silver bull run often starts slowly. The smart money, the contrarians, start accumulating when no one else is paying attention. They see the growing industrial demand and the suppressed price, and they know the spring is getting tighter. Then a catalyst happens. Maybe it's a major geopolitical event, a currency crisis, or a report showing a massive supply deficit. The price starts to tick up. This initial move catches the eye of more investors. The fear of missing out, or FOMO, begins to set in. People who were on the sidelines see the price rising and jump in, afraid they'll miss the train. This is the second stage. The narrative shifts. Mainstream financial news, which may have ignored silver for years, suddenly starts talking about it. You see headlines like, "Is silver the new gold?" or "The industrial metal set to explode." This media attention pours gasoline on the fire. It brings in a whole new wave of buyers, many of whom have never considered silver before. They aren't just buying ETFs, they're buying physical coins and bars, further straining the physical supply. As the price accelerates, it becomes a self-fulfilling prophecy. The rising price validates the decision of everyone who bought in, and it creates intense FOMO for those who haven't. At this point, even some of the institutional players who were short might be forced to cover their positions. To do that, they have to buy, which pushes the price even higher. This is called a short squeeze, and it can lead to parabolic, explosive price moves. The final stage is euphoria. This is when your taxi driver or your barista starts giving you tips on buying silver. The price is going vertical, and it feels like it can never go down. This is often the most dangerous time for new investors, as it's usually the peak, right before a correction. But the journey to get there is fueled by this incredible psychological cascade, starting from a few informed buyers and snowballing into a global mania. So, what are we seeing now? We're seeing the industrial demand picture getting stronger every single day. We're seeing a global community of retail investors who are more informed and connected than ever before. And we're seeing a paper market that continues to play its games. The spring is being wound tighter and tighter. The pressure from the physical side is immense. All it takes is the right catalyst to release that tension. When it does, the resulting move in silver could be one for the history books. It's a fascinating battle to watch, a true clash between paper promises and physical reality. Thanks for watching. If you found this breakdown of the silver market interesting, make sure to hit that like button and subscribe for more deep dives into the world of finance and precious metals. See you in the next video.